I'm going to talk about involuntary conversion. Let's see what it is involuntary conversion. And involuntary conversion results from the destruction, theft, seizure, condemnation, sale, or exchange of the taxpayer's property under threat of the condemnation. Section 1033 of the Internal Revenue Code allows a taxpayer who undergoes an involuntary conversion to postpone recognize of the gain. The taxpayer must reinvest in a similar property as a replacement property to defer or postpone the recognize of any gains that is inherited in the amount of the taxpayer was paid for the involuntary conversion property. Okay, so basically, if you if you have a property that you were forced to give up or have to exchange it to another property, so in the process of this sale or exchange, if you recognize any gain, you probably have to pay tax on it. So that's just something we are talking about here. So I will have more examples to explain what's going on here. So involuntary conversion, if the amount reinvested in the property equals or exceeds the amount realized, the realized gain is not recognized. Okay, what are they talking about here? So basically say, well, you have a property, let's say your older property, then, violation of some tax code, so your government force you to give up, right? There's a property, so then the government says, so you own this property for $200,000. Then government say, I'm gonna write you a check $250,000. So you here just say if the amount of the reinvest in the replacement property equal or exceed. So basically, so if you give up the property, older property, then you have to get a new property. The new property, if you give up $200,000, if your new property realize, if you get the new property is more than $200,000, so then you do not recognize gain, right? Because so it costs you more to get the new ones. So that's basically, that's saying, say if the amount reinvested the replacement property is less than the amount realized, then the gain is recognized to extend to the proceeds and not reinvested. The recognized gain is recognized as a taxable income for the taxpayer. Okay, let's see an example. See what are they talking about. Here, this is the example. Involuntary conversion. Zhu had a property condemned by the state of the Louisiana. The property had a just basis is $26,000. Zhu received $31,000 from the states for the property. Therefore, Zhu realized a gain is $5,000. So $31,000 minus the $26,000, so you get a $5,000. Then assume he now is buy the property similar to use in older property is $29,000. So basically he gave up this $26,000. So then he turn around buy a new one is $29,000. So but he received a check is So basically 31,000 you didn't reinvest it. So then 31 minus 29. So you have a $2,000 extra money. This money has to be recognized as a income included in your current income. Then let's see. Let's talk about the realized. So basically, if you receive cash 31,000, then your older property is only 26,000, cost basis. So this called realized gain is $5,000. So then you reinvest property, you take around buyer property is $29,000. So then you recognize again. This is you have to pay tax on it. So if you receive a check 31,000, then you only bought a new property 29,000. So you have a $2,000 cash in your hand. This cash will be recognized the income. You pay income tax on it. Then you deferred again. Deferred again is, well, you total recognize $5,000. Then you you recognize again 2,000. Then the rest is deferred again 3,000. Why you need to know that? Because your new property, the cost basis is still 26,000. So if you turn around sell this, the new property, right now the market price is 29. If you turn around sell it at 29, so then you will recognize again 3,000. You have to pay tax on it. So anyway, so if in the future, you sell it, you have to know your cost basis is $26,000, not $29,000. So that's it. The example. So here is the involuntary conversion. We talk about the property, the new property, you have to be similar. So basically it says the general requirement to apply the section 1033 is that the replacement property must be similar in service or use until the involuntarily converted property. For an owner use or functional use test applies, while other owner investor and the taxpayer use test applies. So here basically said, let's say the functional, this, so basically say, well, if you give up a residential property, so you probably get another residential property. Functional use basically says the old and the new property must be the same. So if you give up a residential property, then you buy another residential property. Taxpayer use test is the new property must be similar to older one. So basically say there's more flexibility within this test with the functional use test. For example, the proceeds from the office building may be used to acquire another investment real property, not just another office building. So if you give up a office building, then you turn around, you buy another rental property, maybe a residential rental property, or a strip mall or something. So that is meet the test requirement. So basically you meet the replacement property requirement. In there, here say replacement property and time limitation. So basically what did I try to say? Normally the taxpayer has 2 years period from the end of the taxable year in which any gain is realized from an involuntary conversion to replace the property. Okay, so basically there's time limit. You cannot just holding on the money, holding on the check, then forever not go to buy a new property. They basically say, well, within 2 years, you have to go to buy a new property. Let's see an example. So in this one, in June 2021, this person discovered that her safe and has been stolen. In September the same year, she received a reimbursement check from her insurance company. So she has until December 31st, 2023. December, you can see here the time frame. In June 2021, she got stuff stolen. And in September 2021, September she received a check. received the check means she has again realized, right? Then so then she has to until September 2021, then you have until after this end of this year, you have 2022 whole year, 2023 entire year. So you have 2 years after whatever happened in that year to get a replacement property. The last day of the second taxable years following the year in which a gain was first realized. The last day of the second taxable years following the year in which the gain was first realized. So, however, for the condemnation of the real property by the government authority is the reason for the convention. The period is extended to 3 years from the end of the taxable year in which any gain is realized. So from the government, you have 3 years. As this is example, Ken was notified by the city council on the December 2nd, 2017, and if of his intention to acquire by the condemnation his real property used in his business. On June 5th, 2018, the city paid Ken for his property. The replacement period began December 2nd, 2017. The date Ken was notified is the property because Ken did not realize again on the disposition of the property until 2018. The replacement period ended in December 31st, 2021, the last day of the third tax year following the year which the gain was first realized. So basically, he was noticed on December 2nd, 2017, that of intention. Then June 15, 2018, the city paid. So basically, he didn't realize again until June 15, 2018. So you have to count from after 2018. So you have all the way until 2021 because then you have a 3 year. The 2019 the entire year, then 2020 entire year, 2021 entire year. So that's the entire 3 years. So that's the time limitation. So here they have a little summary valuation rule for section 1031 and 1033. So they have a little similarity regarding the realized gain minus recognized gain equal to deferral gain. So that's something kind of similar. So this is comparison. Oops. So realized gain for 1031 exchange is fair market value of the property received minus adjusted basis of the property give up. So how about realized gain for the 1033? Is amount realized, basically received the check, then minus the adjusted basis of the old property, right? Recognized gain occur if the bill received. So for 1031 exchange, you only have a recognized gain when you receive some cash or you have your mortgage assumed. So that's called boot. So then the recognized gain amount is lesser. So whichever is lesser the boot received or lesser recognized gain. Then the recognized gain, because this is not applied to 1033, Then you have a recognized gain. Recognized gain for 1033 is amount realized but not reinvested in the new property. Basically, if you receive a check, you didn't use all the check, right? You didn't use all the check. Then have portion money left that used as a recognized gain. So then deferred gain is equal to recognized gain, realized gain minus the recognized gain. Is the same for 1033. Basis in the like kind property received is fair market value of the real property received in exchange minus the deferred gain. So that's the basis. Basis in the new property is fair market value of the property at acquisition minus the deferred gain. So basically, fair market value, it's your original basis. Okay, this is a little comparison between Section 1031 exchange and Section 1033 involuntary conversions.